So sell in May, go away. How on earth did that become legitimate investment advice? In any other profession, if the professional in question spoke to you in riddles like that, you would think they had gone mad. If your doctor said something like that, you would probably crawl out the window because you would not want that guy coming at you with a scalpel. If you're an accountant, if your tax advisor, anybody like that made those kind of comments, you would not take them seriously. Yet somehow in the trading world on Wall Street, these kinds of expressions are taken seriously. Don't frown, average down, the trend is your friend. By the way, those two would seem to contradict each other. If you're averaging down, the trend is clearly not your friend. But both rhyme, so both must be legitimate, I guess. But let's focus on sell in May, go away. Now, like a lot of maxims and things like that, I mean, there is an element of truth to it. It's true that from November to April, stock returns tend to be significantly higher than from May to October. People have hypothesized as for the reasons why. Perhaps the summer months, half of Wall Street's at the Hamptons vacationing. Who really knows? There may not really be an explanation. It could just be one of those quirks of the stock market. But it is true that those winter months tend to have better returns than the summer months. So that, that winter half of the year over the last decade has done about 8.67% per year. Whereas in that summer half, the part we just started, the May to October, the returns are actually less than 4%. So you're talking about more than double return during those winter months than the summer. Okay, great. That's what the stats say. But should you actually trade on that? Generally, I would say no. And the reason is, in any given year, the summer could actually outperform the winter. I mean, that's not unusual. And the most important point is that during that summer period, from May to October, stock returns are positive. There's really no long-term window you can look at where you find negative returns over that period. Now, there are stretches where it's really flat. The returns might be less than 1%, but it's still positive. And if you look at the individual months, it's really the same story. In fact, July is one of the best months of the calendar year. June tends to be flattish. October and September is actually mildly negative. But that's because those months have been skewed by a few outliers. As a general rule, I mean, unless you're doing just a very, very aggressive short-term trading strategy, it just doesn't really make sense. Now, let's focus on a couple reasons. One, if you're in some stocks that you like the prices you bought them at, and you consider them long-term investments, why would you sell in the summer months, take short-term capital gains taxes, and then only to reinvest a few months later? If you're planning on holding this thing for potentially years, why would you turn long-term capital gains into short-term capital gains and be taxed out the wazoo? That makes no sense at all. But beyond that, think about what we do in Peak Income. This is an income-focused newsletter. We look for durable income streams that will pay your bills in retirement. If you're sitting out for half the year because of seasonal factors, you think, well, the market's going to be weaker that 6-month stretch, so I'm just going to get out. Well, when you get out, your dividend income stops as well. If you're getting those, you're going to miss potentially 2 dividend payments out of 4 for a given stock. That really doesn't make a lot of sense. So sure, sell in May, go away. It sounds cute. It makes for good financial copy. It makes for good headlines. But it's really terrible investment advice. So don't do that. If you have stocks you like, if you have income stocks, dividend stocks that are continuing to pay you every month or every quarter, don't get out because of some silly little seasonal nursery rhyme.